Well, U.S. inflation accelerated at the end of last year to 3.4%. That's the headline rate, the most in 3 months, fueled by services costs and housing prices. However, our next guest believes this inflation print shouldn't impact the Fed's original path to get to that 2% inflation target. For more, let's bring in David Wilcox, senior economist at Bloomberg Economics. David, thanks so much for joining us this afternoon.
Good to be with you.
So this was a big point of focus this week, this inflation data out of the U.S., but it seems to be being downplayed a little bit in the sense that it did come in hotter than expected. But people are pointing to the fact that we weren't expecting it to be a sort of straight line for inflation to come down from where it was and all the way to that 2% target.
Yeah, think of a hiker. This was never going to be a straight line path, and I think today's report was at most a minor stumble along that rocky path. I think it's clear that over the past 6 to 12 months, a lot of progress has been made against inflation. Remarkably, the labor market remains reasonably strong. It has cooled some now so that it's in better balance. I think the door remains open to the Federal Reserve to cut rates probably for the first time in March, not at this upcoming meeting in January, but the one after that.
At this upcoming meeting, then, do you expect the Fed to sort of use some language that would get people ready for the possibility of a cut in March?
That's typically been their habit. They signal one meeting ahead, generally speaking. They'll be careful in doing so to leave open the fact that a lot of news will come in between that January meeting and the March one. They'll get 2 more employment reports. They'll get 2 more price reports like the one that we got this morning. And if anything, the record of the past 3 years has repeatedly shown us that surprises can lie in wait for us. So they'll be careful not to close their options out. But I think what they will do is signal they're on track in all likelihood for a rate cut in March.
What sort of reaction do you think that would get, David? I mean, we know when we're looking at the overnight swaps market that the expectation for multiple rate cuts this year is there already. But if they do signal that a rate cut could come in March, what sort of a reaction might there be? It'll depend on how strongly the committee affirms that they're on track to cutting rates in March. What I expect is not a strong affirmation, not a commitment, but an indication that that's the direction that they're leaning in. That is mostly priced into futures markets right now. So I think a confirmation of that's the direction they're leaning would elicit some favorable reaction in bond markets and probably stock markets as well. But I don't think it would be an outsized response since that's the going assumption already. What do you make of the areas in which we're continuing to see these price increases in the U.S.? I mean, some of them in December seemed like they might be because, it was that particular month. If you're thinking about airfares, maybe people were taking more trips than usual because of the holiday travel season. But were there particular areas that were, of concern to you in terms of the potential for stickiness?
Well, like all of these price reports are, this one was a bit of a woolly mess. One of the areas that's been slower to show any progress has been the housing components of the consumer price index. Those have been pretty stubborn, pretty resistant to coming down. We know that those price increases for rents and for owner-occupied costs, those will decline, contributing further to the inflation reduction. The way we know that is that new lease agreements are embodying much lower rent increases.
it's just a matter of time before that diffuses into the official price index. That's going to be a big part of the story. The other piece of the story will be how much labor costs continue to press up on prices, and the answer there is we just don't know yet.
Well, it did look like wages they're not as hot as perhaps they are in this country. They've been pointed to as a concern in Canada still, the wage increases here, but not as much at this point in the U.S.
The labor market in the U.S. is cooling. There are unmistakable signs of that. The number of job openings has declined a lot. The quit rate, which is commonly taken as an indicator of worker confidence and their ability to find that next better job, quits are down. That's another sign that the labor market is cooling. All of these augur well, I think, for a moderating pace of wage increases. We need to see wage increases come back into line, roughly speaking, with productivity growth plus the Fed's 2% in price target. And so that would mean that a sustainable pace of wage increases, probably in the neighborhood of 3.5%. We're still in the 4 to 4.5% range at the moment in the U.S.
Okay.